Well, good afternoon, everybody. I'm Mac Taylor, Legislative Analyst, and earlier today, my office put out California's Fiscal Outlook, the 17th edition of our annual mid-November report on the budget situation. Let me just take a moment, first of all, to thank all of my colleagues in the Analyst's office. This is a report that really requires input and contributions from just about everybody in the office, so I want to thank them for their efforts. I also want to apologize to this group. This morning we had a little bit of a misunderstanding internally about the release of the report. It was supposed to go out publicly to everybody at 11:30. To the extent that our mishap caused any of you problems or inconveniences, I apologize for that. We'll make sure that doesn't happen again in the future. So let me just briefly summarize the main findings from our report. I think, as most of you know, the Outlook serves various purposes. We update the current year fiscal situation. We provide typically the initial projection of what the budget problem is going to be for the 12-13 fiscal year that starts next July 1. We also provide for 4 years after the budget year the kind of trends in underlying spending and revenues to see what those look like and help the legislature in thinking a little bit long-term about their problems. This year, the Outlook has another important function, and that's because of our role in helping to determine the magnitude of the trigger reductions. And let me turn to that first. We're estimating that general fund revenues in the current year, 2011-12, will be $3.7 billion below the level assumed in the Budget Act. And what that means is that under our projections, there would be $2 billion worth of trigger reductions. All of the Tier 1 trigger reductions, $608 million, primarily to state agencies. And then a good chunk of the Tier 2 reductions, which are entirely within Proposition 98. So 1.4 in Tier 2 reductions, for again the total of $2 billion overall. Now, because we are estimating that we would be in the second tier of reductions, a provision would trigger that would allow school districts to negotiate with their unions the possible reduction of up to 7 days in the school year. So that is an authority they have. It doesn't guarantee that any number of days, whether it's 1 through 7, will actually occur. It just means that they have the ability to do so. I also want to caution that this is not the final determination, obviously, of what the trigger reductions are. In December, the Department of Finance will have their own independently provided revenue forecasts. They will compare theirs with ours. The higher of the two will dictate the amount of the trigger reductions. So I think the way to think about it is we've set a ceiling on how high the trigger reductions can be. They can't be more than $2 billion. If the Department of Finance's revenue forecast is below us, there will be $2 billion in reductions. If they're above us, there'll be somewhat less in trigger reductions. I think it's also important to note that given the variability around revenue estimates, the numbers that come in by the Department of Finance could easily be $1 billion or $2 billion either below us or above us. That would not surprise us at all. So people will have to wait until December when Finance comes out for the final determination on what the trigger reductions actually are. Let me turn to the 12-13 budget problem, because normally this would have been maybe the focus of this type of press conference. We're forecasting that the state will face a budget problem of $12.8 billion in the 12-13 fiscal year. That is, by the end of that year, June 30th of 2013, we have to come up with solutions, either expenditure reductions and or revenue increases of almost $13 billion in order for the state to finish in the black. Now, I think there's 3 main reasons why we have that level of problem. First of all, we knew when we passed the 11-12 budget that we still had an underlying problem. That's because we have several large one-time solutions that when they go away, problem kind of bounces back or shows itself again in 12-13. In addition, our revenue estimates being lower, even though the impact on the budget is mitigated somewhat by the trigger reductions, you still have a loss of solution in effect, or you have an increase in your problem because of our lower revenue numbers. That's not only for 11-12, but also for 12-13. Also, we have solutions that were adopted in the budget for 11-12 that we're estimating will not generate the full level that we assumed. So, for example, we had the redevelopment shift that was going to generate $1.7 billion in savings. We're estimating that because of technical reasons, even if it's the court's rule, it's legal, and we go through it with it, we can only get about 1.4. So that's a loss of solution of $300 million. And we list several others in Chapter 1 of the report of solutions that we identified that we don't believe will materialize. That also can have consequences for 1213. So for all three of those reasons, that's kind of how you get to that $12.8 billion problem. Now, there is probably one good piece of news in the report, and I think that has to do with the out-year forecast. And if you look at our table on page 7, it's one that we've put in the report for many years now. It shows the estimated, projected operating deficits for the next 5 years. And you might remember, many of you in this room remember last year at this time, that chart showed operating deficits that stayed in the $20 billion range throughout the forecast period. And now you see that while it starts at $9.8 billion in 1213, it gradually declines to just over $5 billion at the end of the period. Now, the reason why we cut it in half right up front was because of actions taken by the legislature to reduce spending, ongoing spending for the current year budget. And also, revenues improved throughout the spring of last year. We were actually improving our revenue forecast. And so clearly the revenue situation improved somewhat up to the time that we adopted the budget. Also, we finally pay off those economic recovery bonds that the voters approved several years back. And that obviously frees up money that improves our budget situation in the out years. We don't have any inflation adjustments or cost of living increases in the budget. That's the legislature's adopted that as a general strategy. So these out-year budgets are very tight. They don't grow because of inflation for the most part. But I think it is really good news that the legislature and the governor, through the actions they took this year, made a huge dent into that operating deficit, and that at least on the natural, it does decline. So those are both positive signs. Now, as we say in the report, there's still a lot of work to do. 12.8 is still a large amount of money for general fund budgets that's only $85 billion. So there's still a lot of work to do. And as we also note, even if we get the budget in line in the next couple of years, we still have a lot of other work to do for other budgetary obligations and our pension and retirement debts that we're going to have to address in the very near future. So I think we still have a lot of work to do. And with that, I'm happy to answer any questions.
Revenues are going to increase year over year, yet we're going to face this $13 billion problem. And to what extent is that the legislature is making? I mean, they relied on one-time solutions that can't be relied on in the next year, and didn't get the revenues that the governor and Democrats had hoped for. So, I mean.
Well, I mean, Kevin, last year at this time, we were saying, if you could make a dent by addressing half of your operating budget, you would have been pretty successful, and as it turns out, that's what they did. Again, there's not necessarily a problem in having some one-time solutions. It's just you have to kind of go into your budget situation with your eyes wide open, knowing that the next year the problem will come back. And I think what the legislature and the governor had hoped had revenues improved to the level that they had planned, the ongoing problem, the operating deficit we would have faced, would have been considerably smaller. You wouldn't have had the operating deficit to carry into the year, or at least at the same magnitude. And your operating deficit would have been somewhat smaller. So, I think that, again, they made some progress, but everybody knew that we still had some remaining problems.
Could you talk a little bit about, granted, it's a bit of an overly simplistic way of looking at it, but when you look at the deficit that you all are projecting, it doesn't too closely match off of the $4 billion in additional revenue assumptions that came out of the budget. How much of that do you think is because of that extra assumption that was never actually categorized as where the money was coming from versus other economic factors that are in the mix?
Well, I think your question, John, speaks to difficulty in trying to sort that out, because we do a grounds-up new revenue estimate, and lots of things have changed. The economy has had some ups and downs overall. It's actually a little bit worse, but some of our revenue trends have actually tracked a little bit better. And so when you do a grounds-up, a lot of things have changed. But certainly the $4 billion was something that even the legislature and the governor knew was risky. That's why they put the trigger reductions in. And while the trigger reductions don't mitigate the entire loss of the revenue, they do mitigate a large chunk of it. So You know, people will draw their own conclusions, I think, about the closest of our number to the $4 billion.
Mac, one of the governor, as I said many times, he wants to put some revenues on the ballot next November, maybe $10 billion or something of that nature. Of course, that would be after the 2012-13 budget presumably has been passed. You know, it's gone to budget before. Would it be appropriate or even legal for the governor and legislature to adopt a budget based on the assumption that those revenues would be there?
I don't know the answer to that, Dan. I mean, the budget, the Constitution says when you pass your budget, it must be balanced in effect. So I don't know how the courts would view that, the assumption of future voter approval, whether that you would have a standing and a grounds for action of that. Obviously, it's not the best budgeting practices to have such large contingency budgeting. But I know that was certainly what the governor's plan was. Now maybe as part of that plan, he'll have additional trigger reductions or some other means to mitigate if the proposal doesn't balance. So we haven't seen that plan. And for that reason,
I don't think he's even seen it.
well, for that reason, in our budget assumptions, we followed the language that said if you don't have a proposal, if you don't have revenues that have been approved in November, you then start counting the realignment revenues, the $5 billion that was sent down to counties. And so our budget assumes that those revenues are not there, and our calculations on Proposition 98 were adjusted accordingly because we had no specific proposal to respond to.
Mac, you said that that when finance releases their numbers next month, that you wouldn't be surprised to see a swing of a couple of $1 billion. What sorts of factors would account for such a difference?
Oh, I think the most obvious one, if they have a different assumption on how much capital gains they're assuming for the year. Because most of that money is taxed at a very high marginal tax rate. So it doesn't take too much difference in our assumptions to generate quite a bit of money.
And would there be any more clarity on capital gains in the next 3-4 weeks?
You know, there could be. There is some franchise tax board data that may come in November and help finance. Again, it can go up or down. That's the situation. Or if the market really took a dramatic, longer term, it wasn't just a day-to-day fluctuation, but was looking like it was trending upward or downward, that it could affect how they do their estimates for capital gains. But we're also tracking, we're tracking revenues as they come in. We look at the best available data on both corporate profits, on monthly sales tax, taxable sales at both the national and the state level, and how withholding is doing. And so there's a lot of things. It's just that those latter ones that I mentioned don't tend to move the numbers quite as much as a capital gains number would.
At least one lawmaker has called for taking another look at the trigger cuts, reopening the budget. In your mind, is that wise, not wise to do?
Well, I think the legislature put those numbers in because they knew they would need them to both help balance their current year budget. And then if you look at our out year number, you would think you would want to start those reductions at the maximum amount and continue them on. So, that's going to be up to the administration, though. But we certainly have included the full cuts that were envisioned in the letter in our calculations.
Matt,
Yeah, Mike.
historically speaking, though, have you ever seen such a wide swing of 3.71 billion, 2.7 billion difference between your outlook and Department of Finance's outlook? Has that ever occurred before?
Oh, yeah, I think it's probably occurred lots of times.
So it's not unknowing.
Oh, no, not at all. And again, remember, you can't just look at the difference between what was assumed in the budget. We both do grounds-up forecasts. And lots of things can change. So, again, the variability around our revenue estimates are very large. And what you're trying to do is you're trying to hit that median. You're trying to be wrong half the time low and half the time high. You just know you're going to be wrong, and you hope it's not too much, and you hope it kind of balances out, that you don't have some bias in your revenue forecasting model that you're always low or always high. But we've seen much larger swings than that. So I don't think that's unusual at all.
So nobody should be pushing the panic button or bring out the axe yet.
Well, it's hard to answer that because remember, when I say that they could be different from us, it's both they could be a lot lower than us. Now, that doesn't affect those people who are worried about the triggers because, as I said, they have a cap. Can't get any worse than that. But remember the implications for the budget if their revenue number comes in a lot lower than ours. And that's the number that the administration uses for purposes of January. They'll be defining a much larger problem, irrespective of the trigger mechanisms, and that means that there's going to have to be lots of other either expenditure reductions or revenue increases put on the table.
Matt,
Yeah.
what kind of assumptions did you make about what might happen with the super committee and then other things like payroll tax, inheritance tax?
Yeah, we write about that in here. I think it's where's Jason? In chapter 1, Jason? Chapter 2, excuse me, in the revenue and expenditure chapter, because we had to kind of make some implicit assumptions, either because of the way that we get our forecast numbers from a national company that provides data on the U.S. economy, had to assume something. So we try to lay out exactly what is assumed in there. And again, that's just another area of uncertainty, both on revenues and spending. I would say more so in the longer run, not necessarily in 11-12, or a little bit more in 12-13, but the assumptions can have very significant differences. Whether the Bush tax cuts are extended again, whether the estate tax, the pickups tax goes on at the end of 2012 or 13 or not at all. And we try to outline many of those decisions in Chapter 2.
Matt,
Yeah. Kevin, let me go back here first.
you had said that your revenue forecast would serve as the ceiling for as bad as it could get. What did you mean by that? I didn't quite follow.
Well, again, because the administration takes the higher of the two revenue forecasts, so if we turn out to be the higher of they come in below us, then the $2 billion is what would be triggered.
But what if theirs is worse? Wouldn't theirs be the ceiling then?
No, because you take the higher of the two revenue.
Ah, I see. Okay.
So if they're below us, it doesn't matter. They would take our revenue estimate, which would generate two, which would generate, we would be the row 01.
But if theirs is more negative.
If there's what it does, again, it wouldn't affect the trigger.
Okay, I see.
So that's why I say we have an effect as a ceiling. Judy, and I'll come to you.
I was wondering, the people who would be impacted by the triggers, there seem to be largely students, whether they're in K-12 or colleges, and I wonder, you can talk a little bit about what's happening in the big picture in California for education, and assuming these triggers have to be pulled.
Sure, let's start with education, okay? Because I think the big cut there is on the revenue limits that's in the Tier 2. And we spend a lot of time in Chapter 3 in the education section talking about why it's so difficult to know exactly what will happen. It's because it depends on how school districts handle the proposed cuts going into the year. Many districts just assumed that those trigger cuts were going to go into effect. And for those that did, they set aside reserve, took actions early on, and they may not be too seriously affected, at least this year, by the trigger reductions. For those districts that assumed that they wouldn't go into effect, did not plan, do not have high reserves, they're going to have a much more difficult time, certainly this year, but more importantly, probably next year. So we think that a lot of districts probably played it more cautiously and will have reserves or some actions that they can do to mitigate a large chunk of it, but it's very hard to generalize because there could be a handful of districts that are in very serious trouble and many others that could face some short-term problems and more serious problems in 12-13. As far as the students are concerned, I think because UC and CSU are each would take an additional $100 million if, again, our revenue estimates are the ones that are used. I don't think there's much more that would happen this year. I think CSU has already talked about a tuition increase for next year, perhaps in anticipation of a trigger cut. It's very hard to go ahead and do the tuition increases at this time. It's pretty hard for them to change, who they are going to be. Certainly their current year students, they can't really affect too much at all. So I think you're talking about more serious concerns about how it plays out in 12-13 and 13-14.
And you do assume that these trigger cuts are permanent?
Yes, we do.
Going forward?
Yes, we do.
Okay, that exacerbates their problem, I think.
Well, the only caveat I would say to that is in Proposition 98, because you make the reductions, we feel it gets worked into the base and a lower amount. It may not have longer-term effects once you kind of pay off maintenance factor, but for the foreseeable future, it could lower the base and affect spending in out years also. It just works in a little different way than the other cuts.
But,
yeah.
But on that point, you say that the Prop 98 minimum guarantee will be $4 billion higher in 12-13, and you're suggesting that the legislature needs to consider a suspension of Prop 98 next year. So I guess I'm asking you to expand on that and why why it will come in so much higher next year, and then what and why you're suggesting that a suspension should be on the table.
Well, I think what it's referring to is in Chapter 3. Let me see if I can quickly get the page number. We have a chart that I certainly found very helpful in explaining this, because it's not simple. It's on page 27, Figure 2. And basically, we had a Budget Act spending level of $48.7 billion. With the trigger cuts, that spending level would go down to $47.2. The problem is, we've also had adjustments to our minimum guarantee from two things. We've assumed, again, as I mentioned earlier, that because we don't have a specific revenue measure, that we have to count the realignment revenues, the 1% sales tax, that was shifted to counties to help fund realignment, but was not counted towards 98 by statute. Because we don't have the measure on the ballot, we've assumed that those revenues are counted in the minimum guarantee calculations. So that increases the guarantee. It's offset in part, though, by our lower revenue estimates. So the $49.1 billion that you see there is the net effect of those two revenue factors. So the 47.2 is where they would be spending at. If you adjust your minimum guarantee and then have growth in 2012-13, that's $4 billion higher than where they would be spending in the current year. And what we just offered is that given a $12.8 billion problem, even though your guarantee is $4 billion higher, could you afford to spend at that level given the kind of reductions you need in your budget? So it doesn't mean that it's all or nothing, that you have to maintain them flat at 47.2. Doesn't mean then you'd have to fund them all at the minimum guarantee. Obviously, you can pick them out anywhere in between to give them some growth, but recognize that you still have a budget that you have to balance, and that schools are at 40% of your total budget. You always have to look there for some possible solutions.
So of the 12.8, 4 is this higher Prop 98 guarantee?
Well, it doesn't translate exactly in the way that we do. Not quite that clean, but I think it is fair to say, because of the increase in 98, and in fact the general fund portion goes up even more, because our property taxes are going down in 12-13 because the redevelopment was a one-time thing in 11-12. We got property taxes that we could count towards schools then. That goes away, so that in effect the general fund has to backfill that. And so the general fund portion of 98 grows even faster. And so there will be a lot of pressure, I think, to figure out how do you balance your whole budget and do that and still provide the minimum guarantee to schools. But again, it doesn't mean it's kind of, black or white, that you have to go down to maintain them at that level. You could go anywhere in between those two amounts. Yeah.
So assuming the trigger cuts go in this year based on your projections, back to the schools again, what are the ones, there are schools that are going to be that are in dire straits right now, and that might be affected this year, if not for sure next year. And in your report, I think you mentioned that the remedy is to negotiate for those 7 days. You talked about it briefly earlier.
Well, that's one remedy. That was provided by the legislature and the governor. It doesn't mean that they don't have other things they can do. They can go in and reduce classified employees, non-teachers. If they have reserves, they can use those. They can have teachers' aides and other things like that. So that's not the only thing in order to reach the cuts. It was trying to give them some added flexibility, possibly, to address a shortfall within a very short period of time. Again, there could be a handful of districts that go the more draconian route of asking the state for a loan. It's a long-term commitment, and Jin Kuhn, my deputy for education, can go into more details of why districts would want to avoid that at all possible costs. But there could be a handful of districts that end up there. We think that the vast majority of districts have either planned for this kind of worst-case scenario of major trigger cuts, and so could get through this year. Others that will still have some additional work to do, but hopefully will be able to make it through 11-12. And again, I think we're a little more concerned about what happens in 12-13.
Do you foresee other problems implementing any of the other cuts? I know that there has to be legislation for the development for the DDS cuts, and there's already talk of a lawsuit for the IHSS.
I think we don't see serious concerns, Anthony. Probably more on the IHSS, just because we've had problems with kind of across-the-board reductions before. So I would say that's probably the one that poses some risk, but in general, I would say no, not on the serious legal risk for the vast majority of the reductions.
So can any,
Yeah, go ahead.
so can any of the 3.7 billion shortfall be assigned out to the big three? I mean, is there any part of the big three revenue sources that seem to be noticeably contributing to the 3.7? Or is it just unallocated?
Well,
3.7?
I mean, we have a chart in there that shows
Yeah.
where our estimates differ, but sales tax is a little bit weaker. Hit in corporate's a little bit stronger than we were in May. But because the $4 billion that was added wasn't allocated, it's hard to kind of do anything other than compare where we are now on the big three taxes where we were in May. And we have a chart in Chapter 2 on that.
Let me ask that same question a different way. If they hadn't put in the $4 billion unallocated revenue increase, would revenues be charting where they were supposed to be based?
Yeah.
The budget was based on other, would have been based on otherwise?
It was, pretty close. There were differences in all the tax, not huge differences, but like I say, there were ups and downs on all three. Tracking, fairly closely. But again, Dan, that's because a lot of other things changed too.
Yeah,
If you just looked at the economy, you'd think we would have been down more than we are.
As you said, it was unallocated. Have you ever gotten to your mind, a satisfactory explanation of how they came up with that $4 billion in the first place?
Dan, I think it drove off the fact that in May and June, revenues coming in, the cash flow was doing better than what we finance had forecast.
It was a horseback. It wasn't a full-blown modeling exercise.
No.
It was a horseback educated guess? Or?
I would say it was more of a simple extrapolation of the trends we saw in 2 months. And that's why it was risky. It wasn't based on a full-blown analysis. And again, to their credit, they realized the risk, and that's why we have the trigger reductions.
Also got their salaries back.
For some context, you talked about looking at the deficit number of 12.8, roughly almost $13 billion, in an $85 billion general fund. For context, how big should the public understand that to be compared to where we have been over these last several dire years in terms of percentage?
Well, sure. Just for a simple comparison, last November we were looking at 27, or certainly the problem that we ended up addressing was in the 27, or twice that amount. But I think more importantly, it's not only that we've cut that in half, it's the trend going out is looking considerably better. The fact that it gradually declines, which means that if you could get your budget lines together, you don't necessarily have a problem in the future, because if you look at our numbers, revenues, even though they're not growing dramatically as they have coming out of other recessions, they're growing a little bit faster than what our expenditure projections are. So you don't have an ongoing problem necessarily being out of sync. You just have to get the lines together.
But your out-year projections are based on the trigger cuts going forward.
Yes, that's true.
So if the trigger cuts were turned off after a year, your out-year is going to grow some, of course.
Somewhat, yes.
Let me frame the same question another way. The governor wanted to put taxes on the ballot last year, as you know, first in June, later in the fall. Hypothetically, had those taxes been in place, I think they were around $10 billion a year, it would seem, just in my head anyway, that between the $4 billion is not materializing and the higher spending, it sounds like if they had that $10 billion and everything else had been equal, the budget would have been balanced, would it not?
Again, Dan, it's a little hard because remember you got more 98 obligations with the $10 billion.
That's true too.
So that offsets a big chunk of it, and then you wouldn't have had the $4 billion revenues. So I don't know where the overlap and duplication is here.
Well, you'd had
I think you would have
more in revenue and maybe
you would have
$6 billion more in spending. It would have been good.
You would have been better off as far as your bottom line. It's just a little hard for me to do that off the top of my head. How that?
Like you said, that we're grappling with a deficit that's much smaller than the one we just dealt with. But another way to ask the question, I guess, is how much is this going to hurt relative to the previous year? How painful could this be at a program for people out in California?
Well, again, that's hard to answer because I don't know how that will be addressed by the legislature. Are we going to use revenues, which obviously can hurt individual taxpayers and businesses, but certainly then mitigates the impact on current beneficiaries of state services? Are we going to use one-time things again, come up with new one-time that help us through 12-13, but then shift the problem a little bit to the out years? So, I think the way we look at it is we have made some pretty tough budgetary reductions. and now that you're looking at another 12.8 that you have to come up with, it's still a very daunting task. And yet we certainly encourage the legislature to try to get that problem dealt with, because we have these hangovers of other problems, both maintenance factors and deficit factors in schools. We have all the pension. We have other budgetary responsibilities. So we really need to get our budget in order so that we can address some of those other problems. But it's very hard for me to answer your question, because it will depend on, again, what they come up with.
Mac, is it a mischaracterization to say that if they wanted to bring the two lines together, bring that $13 billion down to zero, and leave the triggers in place, they really only need to deal with $9 billion?
Well, I'm not sure I follow you. The trigger are built in, so they are already reflected in our numbers for 12-13. So the 12.8 already takes into account the triggers being in effect for 2 years.
I got you. So if they were to remove the triggers, it'd be
worse.
$4 billion.
Yes,
okay.
It'd be even
Another
worse.
2, right?
Pardon me?
Another 2, not 4. Because there's only 2 billion.
Right, 2, sorry.
2 carrying over into the final fiscal year, so it'd actually be doubled up, right?
Yeah, remember, a big chunk of it is in Prop 98, so you also have to factor in how 98 plays out. Yeah, Mike.
Given the belief that the trigger helped stabilize the bond markets and assure investors, et cetera, may have worked what it was supposed to do, would you consider it unwise, foolhardy, to go back and try to undo the trigger? What would your advice be if they decided to go back and try to undo the trigger?
Well, I think given the nature of the problem in 12-13, I think it would be unwise to make significant changes in the triggers. The legislature and the governor already agreed that this is where we would take reductions. Now, I'm not going to say that there aren't 1 or 2 or something that they want to make adjustments to. That's always, available to the legislature to make some adjustments. But given the nature of the problem in 12-13, yes, I think it would be unwise to make significant changes to the triggers.
And what message, if we did undo it, what message would that send to the markets?
Well, again, we did it for a lot of reasons. We did it to keep our budget close. We did it for cash purposes, largely. I'm not sure it was as much a consideration as far as the, longer-term debt. I think if we undid some of them, again, I'm not sure it would have a horrible consequence as long as we're maintaining large cash balances and there's no at all threat to the repayment of, say, our RANs. But again, I think from the budgetary perspective, I'm not sure why we'd want to revisit and make any sort of significant changes in the triggers. We need budgetary savings this year, and we need budgetary savings next year.
Speaking of those RANs, you see, assuming the triggers are pulled or some equivalent reductions are made, but you still have, without any other, you still have a carryover deficit in the next fiscal year. Do you have also a carryover cash flow problem? Would the state have difficulty paying back its RANs in June?
No, I don't believe so. Jason, anything? We don't see a near-term cash problem.
Do you see if there's tinkering that can be done with the triggers that are not major changes, that are not? But are there things that you think would make sense in changing the mix of what's things that could have a longer-term benefit compared to what's in the trigger now?
I mean, we frankly haven't looked at that. We just assumed that the legislature and governor made their decisions, and we plugged in the full value of those trigger reductions. And so I think it's going to be more a situation of where do we start looking now for other places to cut or revenues to raise. So frankly, we didn't spend much time. We just assumed that the maximum amount of the triggers would be used.
Mac, last week the controller talked about expenditures as well, that expenditures were roughly 1.5, I think it's 1.7 billion ahead of projections. Is that addressed in your report?
No. I think that was more of a one-time of just things falling into different months. Remember, the controller's cash is a little different from our budgetary cash. And Jason, help me. Was there anything at all that we thought was serious there? I think it was more just a timing differences because of controller's cash and budgetary cash. We don't see anything significant.
So you don't have concern on the expenditure side?
No.
We shouldn't put too much into any 1 month's totals. I mean, it's worth bearing a watch on, but at this time, that 1 month is quite likely just some timing concerns and not worth worrying about at this time at least.
But there are erosions, right? I mean, as you mentioned, the redevelopment money,
Medi-Cal, IHSS, yes. Some of those we're projecting, and the administration might differ with us on our estimates or our view of what they think they can still get or not. But yes, there's some erosions, but we had a pretty good cash balance reserve. So again, we don't see any near-term threat on cash.
On Medi-Cal, are they not retroactively applying some of those cuts that were supposed to have been, had earlier start dates, but of course, CMS didn't.
Todd Bland, or my deputy, and help us.
Some of the Medi-Cal cuts are going into effect. We assume they're going to be approved shortly and will go into effect. So we didn't quite get everything we thought we would get this year. I think we're about $400 million on Medi-Cal compared to the way we budgeted.
So we didn't we didn't assume that they were retroactively, that you went back and got co-payments
On
or
the
whatever.
provider, I think particularly the provider payments, that I think they were retro to June, maybe.
Don't think we went retro, but
We'd have to get back to you on that one. Anything?
On the school piece,
yeah,
you indicated you thought a majority of districts had prepared for this trigger situation.
In some way, yes.
In some way. Do you have any indication of how many might look at cutting the school year as a solution?
No, I really don't. I mean, I think our take on is that it could be very difficult for that to occur often, just because of the lateness in the year and the fact that you do have to bargain it. And remember, many school districts have already shortened their school year between 1 and 5 days. So we didn't think there would probably be lots that would do it, but it is an option.
You don't know, are there districts that have already negotiated that as
a contingency in there? Jen, I'm not aware of any.
We've heard of a few examples of districts that had collective bargaining agreements that did have a contingency plan. If the triggers were pulled, a certain number of furlough days would be added to the end of the year. It's anecdotal, but we've heard a few cases.
But is that shortening the school year or just furlough? I mean, is it the same thing in effect?
It's one and the same in most cases.
On the other side of it, I think people in San Diego use the word bankruptcy to describe their situation if these triggers pull. Have you received any apocalyptic sort of warnings from the school district that some of them might basically go under?
Well, I know San Diego was one I think that we had heard some concerns about, but Jen, any other specifics?
As Mac indicated, there are a handful that are sort of on a watch list. But because the implications for the district are quite severe if they come in for an emergency loan, I think most districts are ultimately going to try to do everything they can to avoid it. But that will mean significant mid-year adjustments.
Anything else?